Jeffrey Gundlach, known as the Bond King, just said there is between a 50 and 60% chance of a recession this year. Now, I will share the clip with you here in this video. It's only about 4 minutes long, but most importantly, what do the numbers suggest what would happen to stocks if we did go into a pretty normal recession? We're not talking like '08 recession, but just a normal historical recession. And what I'm personally doing to prepare for the chance of this, which according to Jeffrey Gundlach is, pull out 3 straws, if you will, and well, don't draw the right one, and the other 2 are recession.
Degree of uncertainty that it's hard to have definitive moves in the market because you just don't know what tariff policy is going to be. You don't know to what degree the economy is going to continue to weaken as well. And I want to ask you about that. On the chance of a recession, the chair said, well, there's always a 1 in 4 chance. Quote, it's moved up, but it's not high. You've had the Treasury Secretary on this very network talk about a detox that is needed. You have had an administration that really has not gone out of its way to talk people off of the idea of a recession. I think in some cases you can make the argument that they have almost telegraphed that you could have one. And if you do, we'll be better in the long run anyway. Your thoughts on all that?
Well, the change in government spending, I hope, is going to be to less government spending. Certainly that is the purported idea of this DOGE situation. And lower government spending is going to lower the pace of economic growth. We've been living on, $2.2 trillion as the actual budget deficit for the last 12 months, $2.2 trillion. And if you're going to get that down to any sort of sensible number, it's going to knock a lot out of GDP. The one thing I think that is really bizarre is people that say that we're going to get growth up to like 3% real or something like this, or even 4%, 5% nominal. And at the same time, we're going to balance the budget deficit. Balancing the budget deficit is not going to help increase growth. That's what the detox is all about. You've got a problem. You know you have a problem. You've got to start solving the problem. And I've been in favor of this for a long time. I think cutting 100, it's kind of disheartening that cutting $100 lousy billion potentially out of the government budget is being met with hysteria, as if that's even a drop in the bucket. It's nothing. So we need to cut a lot more than that if we're going to get to a true detox. So I don't know if that can happen, because I think the cutting will weaken economic growth, which may lead to a counter response. It's one of the problems when you get yourself in one of these vicious circles that we've got ourselves in. But I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
Wow, higher than 50% for a recession.
Yeah, I think it's 50 to 60 is where I am. And I don't think you're going to get a rally out of the long in the Treasury bond market. I think that already happened. We had that Pavlovian response, and we had the 10-year down to 360, and now we're back up at about 4.25, and I'm not sure we're going to go below 4 again, in spite of the fact the economy may weaken.
How much of a risk is stagflation? I read one person's comment today within one news article saying that we already have a, quote, whiff of it, but it's with a small s, not a large S. Is it a real risk?
I think it is. It's certainly non-zero. The tariffs could very well be inflationary, and the inflation rate is going higher anyway because of the base effects of what's rolling off from last year. And so I think they just downgraded GDP, so we're getting closer to recession, and they just upgraded the inflation forecast, although just for this year. I do think it's kind of wishful thinking to think that somehow magically it's going to go back down to 2% in 2027. But I think that forecast is mostly hope that that's going to happen. We don't see. With the Fed saying they're going to cut interest rates and tariffs coming on, I have a hard time seeing how the inflation rate is going to settle in at 2%.
Now, I will tell you why I think there is this issue right now with the economy. Now, I will say Nike in after hours here says they expect sales will plunge in the current quarter as it faces tariffs, sliding consumer confidence, and really just overall uncertainties out there from consumers. They expect low teens or low end of the mid-teens range. So you're talking like 14% decline on sales quarter over quarter. That's rough. You also have FedEx here in after hours. That is, quote, the latest company to sound the alarm on the U.S. economy. Now, call it Walmart, Dollar General, Target, Best Buy, Lowe's, pick the company, and odds are they have negative things to say about the consumer. Why is this happening? Well, fundamentally, I can tell you, probably not a lot has actually changed so far. But what has probably started happening is people are cutting back, okay? What do I mean by fundamentally things have not changed? Well, you probably are not seeing massive job losses at this point, but you're seeing the first kind of sign that that could be coming, okay? And that is really the consumer slowing down. Imagine it like this. Donald Trump just signed an executive order today in after hours, for better or for worse. This is not political, but the Department of Education is soon to be done, okay? Well, that puts the rest of the 3 million government employees in a bit of a panic, I would imagine. If I worked for the federal government, I wouldn't be confident I would have a job next week, okay? There's 3 million federal employees. But what a lot of people fail to forget is there is actually 5 to 10 million additional employees that their companies take in 70% or more of the revenue from government contracts. So you have Doge and this fiscal austerity, which I think needs to happen. Unfortunately, it's a good flush out, wash out, get the government out of the private sector. But you potentially have like 13-ish million people that are facing job insecurities right now. That's almost 8% of the workforce, if the numbers are accurate, and there's 168 million total workers in the U.S. economy. That's almost 8%. So now all of a sudden you have what could be 8% of consumers, essentially, that don't know if they're going to have a job next week. It's highly uncertain. And to a certain extent, I think the damage is already done. If you want my honest opinion, question is, does that push us into a recession or not? Now, let's face it. As Jeffrey Gundlach said, I mean, Doge, whether you're looking at the, U.S. debt clock coming in at 223 billion, or you're looking at the audited numbers, if you will, around 100 billion of savings, who cares what the number is? I think it's more psychological at this point for a consumer that's really been in a recession for a long time. For the lower middle income consumers, 50% of all dollars spent in the economy come from the top 10% of income earners. Now, the wealth effect could be starting to bite those higher income consumers. These are individuals that own stocks, that probably own fancy homes, that maybe are business owners. You add tariffs into the mix, and yeah, businesses, they're not making any quick decisions to invest capital here or there or hire people based on the current tariff environment. It's not happening, okay? You're basically at a standstill at this point for invested capital, okay? So there's that. But you also have homes that are just bogged down. Nothing's really happening with homes. A lot of markets, home prices are declining. And then you have stocks that are down 8% from all-time highs, which doesn't look like it's getting better anytime soon. Mix all of this together, and yeah, this could be a catalyst for a recession. Even as Jerome Powell said yesterday, Jerome Powell, the put is back from Powell. If things get worse in the economy, the Fed will cut. Now, Powell said uncertainty 30 or 40 times yesterday. They have no flipping idea what's going to happen next. And unfortunately, I don't know if Powell was 100% accurate with you. I think while they don't know what's going to happen, they have a pretty good inclination that we're not going to see a surprise to growth anytime soon. That you're probably going to see things get worse from here, again, before they get better. And yeah, Jerome Powell doesn't want a recession, but can he really stop it? Much the same way as the Fed raising rates really didn't hurt the economy too much, because 70% of the economy is services and people spending money anyways. Does the Fed cutting rates really help things much if layoffs already started or are starting soon? Probably not. So yeah, in the short term, markets might like that we have a friend in Powell, like you have a friend in me, what's that movie? Toy Story. Yeah, we might like that short term, but is it something durable during a recession? Probably doesn't help save the day, okay? At least not at first. So you kind of have this dynamic at play right now. And the issue that I see is, yes, you're down 8%. From a structural standpoint, it looks ugly. Why? Because the RSI is now back to 41, and you're only 2.5% off of your lows. Theoretically, you could fall 3% tomorrow, hit a new low, and the RSI would probably fall to like 37. Okay, so to get back to oversold from here, you could fall again more, materially. Same is true with the VIX, that is now down to 19.8 from being at almost 30. Now, if you fall to new lows, the VIX is probably not going to be at a new high, right? So you've kind of reset your volatility measures. I think the VIX could come down a little bit more, probably to 17 or 16. The RSI could probably get back to the 50s. You could get closer to the 200-day moving average again, maybe even bounce above that with such a news headline-driven market. But you're kind of setting yourself up for another fall. Now, ultimately, I don't know what's going to happen. I do agree with Jeffrey Gundlach. I've said for a long time now, for the last couple of weeks, there's probably a 50% chance of a recession. He says 60-ish%. That could be possible. 50% coin toss. That is roughly where I would put things as well, and where I have put the probabilities of a recession. The really difficult part about markets right now, and why I'm not super bullish going out and buying the dip like I would love to, okay, is because of the downside risk here. The downside risk is 5 times larger than the upside, in my personal opinion. Why? Because I think with the current environment that we have, again, we're not going to get growth surprises to the upside anytime soon, in my opinion. Just to get back to all-time highs from here, or get to like 620, call it an 8 to 10% rally from here, would be generous. It would be really, really, really generous. Okay, even by the end of this year, all things considered. Now, certain stocks in the S&P could obviously do okay in that environment of avoiding a recession, but I'm not expecting indexes are going to rip to new all-time highs anytime soon. And if we have kind of the average recession, you're going to be looking at a market that's down 40% from here. So if the upside's, 8%, 10%, downside's potentially 40%, you're looking at a potential of 4 to 5x larger downside than upside, all things considered. And if a recession's a 50% chance, I don't like that. I don't like those numbers, okay? And a 40% decline from here would put you back to lows of 2022. Like, could you even fall lower than that? I think you'd have to have a pretty bad recession, but it would be possible, okay? So think about it like this. This might shock a lot of you guys, but right now, Wall Street is still expecting between 11 and 15% earnings growth, EPS growth this year for the S&P 500. Great. What if I told you from the year 2000 until today, the average EPS growth rate for any given year was 5.25%? You are double or triple, depending if you're looking at the low side or high side, double or triple the average growth rate expected for this year, right? For EPS growth. In this environment, are we crazy or crazy? There's only 2 logical outcomes there. Okay, fine. But if we go into a recession, then you could take 2024's EPS number of, it looks like it's going to be about 237, and cut that down by 15%. Minus like 2008, where you had a lot of financials that just bled money, a lot of companies like way negative EPS. It skews the numbers. So take out 08 in this recession dynamic, and you're looking at an average EPS drawdown of 15% year over year. So you could take 237 as your EPS number. Times this by 0.15. You're looking at $35.55. So take, I'll just pull up another calculator because I don't want to get these numbers wrong by any means. I mean, God forbid we're off a little bit. That would definitely be a crisis. You're looking at about $201.45 for 2025 EPS. If we go into recession, historically speaking, okay? Nobody's prepared for that. No, we're still expecting double to triple your average EPS growth this year, let alone a negative 15% EPS growth number, okay? Yeah, that would be far off of consensus. Way, way, way off of consensus. Now, the average, well, okay, so on the low side of recessions, EPS multiples, PE multiples, tend to bottom at about 13, okay? That's pretty extreme. On the high side of recessions, multiples tend to bottom at 17, which may be closer to what would ultimately happen, but I still think that's pretty high. At the midpoint, you're looking at about 15 and a half. So times 201.45 times 15.5, you're looking at 3,122 on the S&P 500. That's roughly 312. Okay. Well, what do you know? That's gonna put you down near 2022 lows. Actually, lower than 2022 lows. Excuse me there. That would put you down about 45% from here. If we kind of get the average recession, average EPS drawdown. Sorry, guys, you're not priced for a recession. You're not even close to priced to a recession. I don't even think the risk reward looks good until markets are down about 19% from here. That's where you have about a 1-to-1 parity, where if you don't go into recession, you could rally 20%, right? If you do go into recession, you fall about 20% more, okay? Once you get down to about 500 on the SPY, it becomes a little bit more attractive to be buying this market. But not here. You have another 9-ish% from the lows to fall before that looks even at a risk parity type of level. That is the problem right now. The other problem I see right now is there's only a 50-50 chance of a recession. Maybe they're all right this year. In that scenario, you want to own stocks. You want to have exposure. So what I found is my core positions, I have not sold any of them. We're talking Tesla, we're talking Dollar General, like a lot of stocks that are already down a lot, AbbVie, some healthcare names, Humana, right? These are some of the stocks that I own. I don't want to get rid of those names because if we don't have a recession, I want to be exposed to this market. But I'm also not buying anymore right now. I bought a little bit of Tesla and I will continue to average into Tesla as it's down 50% from all-time highs. But I want to have as much cash as possible on the sidelines. Now, I also have some calls on TLT, things like that, but we're not going to get into that too much. Bonds, I think, is a pretty good bet this year. Again, about a 50-50 chance you make a lot of money in bonds. Either way, I do think you're going to probably outpace the S&P no matter what in bonds, my opinion. But again, you don't know what's going to happen here. But with a potential 40-45% decline, you want to be prepared nonetheless, okay? If you do even, on the high side of recessions, 201.45 for EPS times 17 for the multiple, you're still looking at 342 on the SPY, which is almost exactly 2022 lows, a little bit higher. 242 is going to put you down about 39.5%. Like, no way in hell am I going out and going all in this market right here. The downside risk is way too large. And again, in the unfortunate event, we did have a 40% drawdown from here. The last thing you would want is to not have cash ready to buy. That means getting out of margin. That means even if you own stocks, right? You have a full-on portfolio that you get killed on the way down. At least if you don't have margin, you'll be able to margin if the markets are down 45-50% from all-time highs. That margin, if you margin at the bottom, could do you a lot of good. Obviously, you want to be careful with margin, contact a financial advisor. This is not financial advice, blah, 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 all of that. But that's kind of how I'm going about my portfolio right now. You want to be prepared for either which direction this thing goes in. But understand the downside risk is larger than the upside risk in terms of, missing out on this market by magnitudes. And, that's kind of different than any other position we've been in quite a long time. So ladies and gentlemen, let me know what you think about this down below in the comment section. For tomorrow, all you really have is Fed Williams that's going to speak at 8 o'clock in the morning. We know there is at least one person on the Fed that is a bear right now. You see GDP estimates for 2025. One individual is between 1 and 1.1%. But look at this, 2026 and 2027. There is one individual on the Fed that thinks the next couple of years could be really low growth. Right? There's one person at 0.6 to 0.7% GDP, like for both of these years. We want to see, do Fed officials start to sound more concerned about the economy now that their blackout window is over with and there's been some data in recent weeks? Or are they more concerned about inflation? I think that'll tell us more about what to expect from the Fed this year. So let me know what you guys think about this down below in the comment section. Anything, again, can happen in the short term. Wouldn't surprise me if a good headline comes out from Trump or something that sends markets higher, or vice versa, sends markets lower. Very news-driven market until we get economic data. And we really don't have anything to react to tomorrow. Tomorrow is a big options expiration as well. So that's going to add to some of that intraday volatility nonetheless. But again, you guys, let me know what you think down below in the comment section. Have a great rest of your day, and I will see you in the next one.